We are jumping straight into Opendoor today. And, well, if you've been watching the markets, you know exactly why.
Mm-hmm.
That initial surge in price action year to date has been just monumental. It's been sparking headlines across every single financial news outlet.
It really has.
But if you just focus on that incredible stock run, you are absolutely missing the real story here.
That's right.
This isn't just about technicals or some speculative buzz. The real narrative is a complete operational overhaul. Management has shifted to an AI-first platform they're calling Opendoor 2.0.
Right. It's a total transformation of the business model.
A technological transformation. And that's what we need to break down.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're finding value in what we're unpacking here, please make sure you subscribe, hit that like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's unpack this. It's a huge, complex business, and we need to evaluate the true bull case versus the very real bearish risks for Opendoor right now.
Where do we even start?
I think we have to start with the sheer scale of the operation, because for a company that gets so much speculative attention, it's easy to forget this is an organization that moves billions of dollars of housing inventory.
Billions. So when you say massive operation, how does that actually translate into hard numbers?
Okay, so look at the trailing 12 months revenue, the TTM. It's substantial. We're talking around $5.15 billion.
Wow.
That figure alone just confirms their massive scale and their presence in residential real estate.
But there's a catch there, isn't there?
There is. It also tells a cautionary tale. That revenue number, it actually reflects a really sharp year-over-year decline of about 25%.
Okay, so they're a major force, but they're shrinking.
They are shrinking in this really challenging housing environment that we've seen over the last year.
And that leads right to the profitability puzzle, which is, I mean, it's the great tension in this whole story. Despite that multi-billion-dollar scale, we're still looking at a pretty significant net income loss.
A very significant loss, about $305 million on a TTM basis.
Yeah.
And their EBIT margin, so earnings before interest and taxes, are stuck in negative territory, hovering around, say, minus 4.5%.
So why? In the face of these sustained losses, why are sophisticated institutional investors still so intensely interested?
The answer is their balance sheet strategy. They have successfully built what we can really only call a liquidity fortress.
The liquidity fortress.
Yeah, they are sitting on a very, very robust cash position. We're talking over $1.45 billion in readily available end cash.
Okay, so that cash gives them the time, the runway to execute this big pivot. But how strong is their financial position relative to their mountains of debt? This is a capital-intensive, inventory-heavy business.
That's the critical point. And their liquidity ratios are, for this kind of business, exceptionally strong. We're seeing current ratios ranging from 2.8 up to 4.4.
4.4.
Depending on the quarter, yeah. To put that into context for you, a current ratio of 4.4 means they have almost $4.40 in accessible assets for every single dollar of short-term debt.
Okay, that's a serious buffer.
It's a huge buffer, and it's the primary reason smart money feels they have what they need to survive these prolonged housing headwinds.
Is there anything else in the numbers that's pointing to a turnaround?
Yes. And this is even more compelling, I think. It points directly to improved management discipline. It's the recent inflection in their operating cash flow.
It went positive.
It flipped positive to hit $823 million. For an iBuyer, a company that usually just chews through cash to buy and hold houses.
Right, that's their whole model.
Seeing such a strong, positive operating cash flow, it just suggests they've achieved much tighter inventory management. They are selling the homes they buy faster and more efficiently than ever.
That reframes the whole financial picture. So they have the money to survive the storm. Now, let's talk about the engine they built to actually win. The core of the bull case, this Opendoor 2.0, this is the AI moat.
This is the whole AI moat, and frankly, it's the reason the stock has tripled.
That's so special about it.
What's truly fascinating here is just the sheer velocity and efficiency AI has brought to the table. Their competitive advantage is no longer just being an iBuyer, it's being the most automated iBuyer.
And the speed of the rollout has been fast.
Unprecedented. Give you an example.
Okay.
Automation. The AI platform achieved nationwide coverage. So it could algorithmically price houses across nearly every single U.S. ZIP code in just 10 weeks.
10 weeks. That's That's insane.
It is. If a human team had tried to do that, to build and calibrate models across thousands of little housing micromarkets, it would have taken years.
Years, easily.
They compressed that entire effort into a single quarter. It radically reduces their pricing risk because they're not using old, stale data.
Right. And that automation, I assume it translates directly into transaction velocity.
Directly. The AI has essentially doubled their weekly home acquisition speed. They went from about 120 homes a week to 230 homes a week in late Q3 2025.
It's doubled.
This high-velocity model lets them operate on tighter margins because they just turn over their capital that much faster.
But the ultimate metric for the bull case, the thing that justifies the long-term investment, has to be efficiency, the cost discipline.
And this is the centerpiece of the whole profitability argument. They cut adjusted operating expenses by a remarkable 41% year over year.
41%.
Think of it this way. They basically trimmed the operational fat equivalent to closing down, I don't know, a dozen regional offices overnight. But instead of layoffs, they just replaced those manual processes with code.
So they're leaner than ever.
Leaner than ever. Spending only $53 million on adjusted OPEX in Q3.
That 41% cut, that gives management a genuine claim to profitability.
Yeah.
And they are not shy about their goals, are they?
Not at all. They're aiming for adjusted net income profitability by the end of 2026.
An aggressive timeline.
Very. And it is entirely contingent on the continued execution of this AI-driven efficiency.
And it's not just retail speculation fueling this, right? We saw a big institutional vote of confidence.
A huge one. The quantitative trading firm, Jane Street Group, disclosed a substantial 5.9% stake. That's 44 million shares.
And the market reacted.
Instantly. It sparked a big after-hours rally. When smart money like that makes a move, it signals a high conviction that this turnaround story is, it's legitimate.
Okay, so here's where it gets really important for you, the listener. For every bull shouting about AI efficiency, there's a bear citing undeniable risks. So let's introduce those hurdles that have kept so many investors on the sidelines.
The biggest risk is external. It's completely out of Opendoor's control. It's macroeconomic pressure.
Interest rates.
Interest rates and the U.S. housing cycle. The headwinds are fierce, and high rates suppress both volume and velocity. We saw it in the Q3 2025 revenue.
Right, it was a miss.
A slight miss, came in at $915 million instead of the $922 they were expecting. When the macro environment is this volatile, Opendoor's model just amplifies that.
And you mentioned the lack of gap profitability earlier. Let's go back to that internal risk. While they're focusing on adjusted metrics, the sustained lack of profitability under standard counting principles is a major concern, isn't it?
Absolutely. The $305 million loss we talked about, that's the gap reality. And when you look at their balance sheet, they are highly leveraged.
High.
Their debt-to-equity ratio is sitting at 3.46.
Wait, 3.46? That is extremely high for a company with a history of inventory losses and that kind of cyclical exposure.
It is.
Doesn't that liquidity fortress you mentioned just, mask this underlying debt risk?
That's the core tension. And it's exactly why the stock is still so controversial. The high leverage means they rely heavily on debt financing.
Which is expensive right now.
Very expensive. The liquidity fortress is a temporary shield, but it doesn't solve the problem. They have to achieve sustained gap profitability soon, or they will outrun that cash cushion. The AI platform is their only plausible way out.
And when you combine that risk with the nature of the stock itself,
You get extreme volatility. The stock's beta is 3.6. For listeners, a beta of 1 moves with the market. A beta of 3.6 means for every dollar the market moves, Opendoor moves $3.60.
it's a financial slingshot.
Exactly. Fantastic on the way up, but brutal on the way down. Plus, you have high short interest over 13%, just waiting to pounce on any misstep.
Okay, so a company fighting macro headwinds, weighed down by debt, but showing incredible quantified technological progress. Let's shift to what the charts are saying. What's the technical analysis show?
Technically, the overall trend is unambiguously bullish. The stock is trading comfortably above both its 50-day and its 200-day moving averages. That's a classic signal for momentum followers that we're in an accumulation phase.
I saw a big test of that recently, didn't we?
A massive test. In December, the stock dropped 21% after some profit taking. But a critical support level formed really firmly right around that $6 mark.
NAO.
Then bounced strongly. That suggests the initial profit taking is fading and new high conviction accumulation is happening at these lower levels. It affirms confidence in that AI turnaround story.
And are the momentum indicators backing that up?
Yes, absolutely. We're seeing signals of hidden bullish divergence. That means while the price might be moving sideways, the underlying buying pressure is still building. The momentum is there, especially after that institutional accumulation from Jane Street.
So what's the overall market sentiment then?
It's still mixed to neutral among analysts, but the stock itself, it reacts overwhelmingly positively to strategic operational moves.
Like the leadership hires?
Exactly. The new president, Lucas Matheson, the CFO, Christy Schwartz, the market is valuing execution above all else right now.
So the price action reflects optimism about the tech, but the skepticism is all about the timeline to profitability. Okay, to help everyone navigate this, what specific events should they be watching over the next 3 months? What's on the catalyst calendar?
The immediate high-stakes event is the Q4 2025 earnings report. That's coming in early February 2026.
That's a huge one.
It is absolutely crucial. And the focus won't just be on the headline revenue, which is guided between 800 and 875 million. The real number to watch is the contribution margin.
They guided for 5 to 7%.
They did. And that contribution margin figure, that is the validation point, isn't it?
It is.
Hitting that 5 to 7% confirms the AI efficiency gains are translating into actual viable unit economics. It's the first major test of that whole 2026 break-in target.
Okay, what about institutional flows? Is the Jane Street buy a one-off?
We'll get clarity on that in January 2026 with the 13F filings. We need to look for broad-based accumulation. If we see sustained, high-conviction money flowing in from multiple firms, it confirms the narrative has broader acceptance.
And the third catalyst?
Is external. Macro data. Keep a close eye on the January Fed minutes and the housing data. Any strong signals of potential rate cuts later in the year could provide a huge structural tailwind.
It would be a massive environmental boost.
A massive boost. Lower rates would just magnify the efficiency gains they're already achieving.
And finally, let's touch on the speculative stuff. The high-risk, high-reward buzz.
Right. This company is a magnet for M&A chatter. After they bought homebuyer.com, there's been talk of more strategic takeovers.
And partnerships.
And persistent whispers of partnerships with big digital banks or private equity players who want their data and scale. Unconfirmed, of course, but the kind of headlines that could cause a massive, immediate price surge.
So what does this all mean for you, the listener? Opendoor is a highly leveraged bet on the intersection of deep technology and a cyclical, interest rate-sensitive market. They have demonstrated unprecedented operational efficiency through AI.
That 41% cost cut, the doubled acquisition speed.
And they've built that liquidity fortress to buy themselves time. The core tension, the final thought we'll leave you with, is this. Can that proven technological efficiency, which is measurable and repeatable, outrun the very real and immediate headwinds of the U.S. housing market, which remains unpredictable? The data suggests the race is tight, but the company's undeniably moving faster and leaner than ever before. If you haven't already, subscribe so you don't miss our next analysis. We'll catch you on the next one.